Hello everyone and welcome to the channel. My name is Brent and in today's video we are going to be doing a quick update to the channel and our Facebook page here on YouTube. Then we're going to go ahead and jump over into the Avging finance portfolio. We're going to go ahead and discuss 3 stocks that we are selling here on Friday and stocks that we are buying on Friday. Kind of transitioning money. We're going to be completely selling out of 3 positions. I'll go ahead and cover why I am selling out of these 3 positions, and then moving that capital into other businesses that I believe have a higher potential for growth, not only in capital appreciation, but also in just continued growing and paying out those dividends, which is what the M1 Finance portfolio is around. So with that said, if you are brand new to the channel, have not yet subscribed, go down below, hit the red button to subscribe, make it gray, hit the bell to be notified every time I release a brand new video, and of course give this video a thumbs up, make it blue, and let's go ahead and get into the video. Okay, so some of the main changes that I've done on Thursday here today was that I went ahead and revamped the Facebook page and the YouTube channel. Now, we went ahead and changed from the financial investor over to Brent Metters investing, and I kind of changed up my YouTube and my Facebook page to kind of showcase that. So we'll still be discussing quite a bit of stocks here. One of my, stocks are so easy to discuss versus real estate. I kind of chopped my own foot off. I think, I don't know the saying for that, but I stopped investing in real estate back in 2019, I think was the last time that I bought a home, just because in 2020 we were looking for a home. Well, we started looking in March of 2020. We made multiple offers, I think 5 or 6 different offers, continued to get outbid on multiple offers, and eventually around August we found a construction company that was building homes in the home style that we wanted. 4-bedroom with an office. They build a ton of these homes, so we were able to get into it really inexpensive versus where we are at right now here in 2021. So we're really happy. And once that's all behind us, where we moved and we're selling off our current home on Monday, we'll be more focused on creating content here on YouTube and jumping back into real estate, even though it has skyrocketed. And most of my properties that I bought back in 2018, 2019 have almost doubled. So it's crazy what the market has currently done to not only the stock market, but real estate as well. Okay, so that's enough of the channel and all that little stuff. So let's go ahead and get into M1 Finance, talk about some of the portfolio, where we're at, some of the recent activity, and what 3 stocks we are planning on selling off, and what 3 stocks we're planning on buying today. Okay, so overall, we can take a look here at the overall portfolio. We're up a little over 9,000 now. I think this is the portfolio's now all-time high right now. And that is amazing. We've made nearly 7,000 in market gains and a little over 2,000 in earned dividends just within the last 3 years. So that is really good performance. And I'm not sure how the next several years will go, but continue to stay tuned here on the channel, stay subscribed, and we're going to go ahead and showcase where these portfolios go to and get to in the future. But we've had our big beast here, Apple. That's our top performer, followed right behind by Main Street Capital and ABM Industries. I did have a limit buy of Main Street Capital of $5,000 or so. It was 126 shares. It never got triggered, so don't use limit buys. When you find an opportunity out there in the market in a position that is dipping and offering you a really good opportunity, don't set limit buys because it won't trigger it. It'll come within $1 or 5 cents of your limit buy and just will never trigger. So if you see an opportunity out there and it's undervalued in your mind, go ahead and just market buy it or set the limit where it's at in the market at the time. Otherwise, you may never get those shares. And Main Street Capital has been blowing up right now. So I did cancel out my buy and kind of holding off on that one a bit. ABM Industries here, up really nicely as well. Now we do have a couple positions that are currently down in the negative. IIPR, Innovative Industrial Properties. This one was recently added into the portfolio, so that's completely fine. I don't care the performance right now. If it goes down another 5-7%. I'll probably continue to average more into this one. I want to start beefing up my positions and consolidating down my portfolio. So that's why we're kind of removing 3 positions, and we're going to be adding 3 existing positions that we're trying to just beef up in the portfolio. And then Simon Property Group down here, down 29.12%. So that's some of the overall performance of the portfolio. I posted a screenshot of my portfolio, the overall performance here back right there on April 9th over on Facebook, along with a link to the M1 Finance portfolio if you guys are interested in that. As far as buys go, we haven't been funding this account in quite a while. I think the last time that we funded it may have been back in February. So let's go ahead and go to next. And it may have been even further behind there. So it looks like back in January, I thought I had funded it a little bit in 2020. So if I go to my funding history, yeah, in 2021, I've only put $360 into the account. So this account has only been funded with 2018, this 11,000. I get this question in every video that I release where they see that I have 11,000 invested there in 2018. That's because in any year, up until you do taxes or April 15th of that year, you're able to contribute to your Roth IRA or IRA for the past year. So back in 2018, your your max contribution was $5,500. So all I did during this time was I put $5,500 towards 2017 and $5,500 towards 2018. So that left us with that amount of 11,000. 2019, we contributed another 6,000, and in 2020, we put another 6,000, and in 2021, we put $360. So our base investment in this Roth IRA is $23,360. But as you can see here, our portfolio is sitting at $33,671. So that's a $10,000 difference. Even though our market gains are only $1,000, there's a $1,000 difference there, right? So that comes from those dividends that have been paid out to this account that have been reinvested. So all the dividends that we've been paid out in this account have been 100% reinvested and have allowed us to get market gains off those dividends. So there's $1,000 of dividends that have been reinvested plus the 9,000 and some change of capital appreciation and dividends that have been continuing to grow from this. Kind of weird, it's that snowball effect, the compounding effect. So your dividends are buying up shares and those shares are paying you dividends, and it just continues to compound and compound there. So eventually over time, there'll be even a bigger difference there. So we've covered some of the history as far as our funding goes. We have had quite a bit of dividends get paid out in 2021. I really haven't kept up as much as I should have. I know over on Instagram, if you guys follow me there, I do post or try and post every month the dividends that were paid out for the month within the M1 Finance portfolio, or I try and include other accounts as well. So I'll probably do that again. I know it's still, mid-April right now, and I haven't posted it for what we got in March. So I'll probably do that just for fun. And jumping now into the stocks that I'm planning on buying or selling here. So kind of going into my holdings here and sorting by my unrealized gains. There's a couple positions that I do want to move out of. I know I posted AT&T over on my Facebook page. I posted, can HBO Max help AT&T? Can they help them out? So let me know down in the comment section below. Do you believe that HBO Max can help turn what AT&T is currently into something more of a Disney, a Netflix? Can HBO Max help them grow out of where they are currently at? Right now, when I had looked at AT&T, they had an estimated earnings per share of $3.18 and a current payout ratio of 65.41. So these ratios in itself were not bad. Their 3-year revenue was up roughly 8.46%, but when I looked at their 3-year net income, it was down some 116.2%. So I can actually kind of pull that up here and show that I wasn't really going over, if we look at the 5-year, I believe is what we were looking at, and let's go ahead and put their earnings per share. So here we can see that their revenue is 171.7 billion, and it's been decreasing since about mid 2019. And then here we can take a look at in their earnings per share here. So they had a really nice earnings per share movement between 2018 and 2020 first quarter, looks like. And then as of first quarter 2020, their earnings per share has just been declining and declining. And that dividend gets paid out from that earnings per share. So every year, let's see, AT&T pays out $2.08. So their earnings is dropping here to estimated $3.01. So if that earnings per share continues to fall and fall, that payout ratio is going to get higher and higher. So overall, AT&T is the stock that I do plan on selling in the future. If it ever comes up to that $32 price, I'll probably sell it off right around there. I'm profitable because of the dividends, but the dividends haven't always been reinvested into AT&T. I'll try another position I'll probably end up moving out of in the future just when it does recover, along with Semi Property Group. Now, as far as the 3 positions that I am moving out of, I kind of had them here. I had Caterpillar. Caterpillar in itself isn't a horrible company. It is going through actually something really positive right now. We can see that the stock price is currently $232.52 here. So it recently hit an all-time high. This could continue to move higher into the future. But when I'm looking at this company here in the short term, or that's why I'm looking at it right now, it's going to short term reallocating funds within the portfolio, and I look at where this company is at right now. Let's look at their PE ratio, not forward, but just overall price to earnings ratio. It's a asset-based company. So if we take a look at their financials here, we can see that their stock price has essentially hit an all-time high recently around 232. But if we look at their revenue here in the orange, it's been decreasing since about mid 2019. Revenue has been steadily decreasing. If we look at in the blue, their net income, let's go ahead and get rid of some of this other stuff at the moment. So here, let's just look at over the past 10 years. That doesn't I mean, you can see the revenue here over the past 10 years here. You can see that the revenue has been kind of dropping. Their net income isn't horrible, but if we look at it, let's just look at it percentage-wise. Net income is up 133% over the past 5 years, over the past 3 years. So here in July 2019, it had a little bit of a point right here, where right prior to that they had their last, let's go ahead and bring in their earnings per share. Earnings per share here. So we can see that their earnings per share had that high here prior to July 2019. And then as of this point, their earnings per share has been just steadily dropping. And their revenue's been already kind of dropping over the past several years. Net income and earnings per share kind of following suit. But their stock price is still extremely high. And their PE ratio, if we take a look at this one here, I purchased this one, I believe, back in 2018, 2019, where their PE ratio was down in the mid 15, 16s. Right now, Caterpillar is trading at a PE ratio of 42.59%. So I'm just kind of looking at this one, and I'm just thinking, I don't, it's not that I do not like Caterpillar, but I believe at this time, especially within a Roth IRA, so I can buy and sell anything within my Roth IRA, and I don't have any tax repercussions from it. I don't have to pay taxes on it, which is very nice. So at this time, I'm going to go ahead and take Caterpillar, sell my shares out of it at this current high. Now, the stock could gain another 10, 20, 30%, but so could the other positions that I'm moving into. I think they're a little bit more risky with this one dropping. Consolidated Edison is another one here recently. went positive in the portfolio. So if we take a look here at Consolidated Edison, it should be around here, right there. It's up 1.38% total return over the past several years that I've earned this one. So it's up 1.38%. And we did cover this one in another video. When I had looked at them over the past 5 years, this company has been trending lower. So if we look at their earnings per share and we look at their revenue and earnings per net income, we can see that their revenue has, it's a utility. So it's not expected to grow, but I'm trying to transition my portfolio to be less stable and have more growth at the moment. So Consolidated Edison is just one of those positions that I feel it's at a good opportunity right now just to kind of cut where it's at. I'll still be positive. I'll still have collected those dividends, but I'll just allocate those funds into something just a bit with a higher return in the potential future. So it's not that this company isn't bad at all. It's just that it's slow and steady, and right now I don't want that in my portfolio. So nothing against Consolidated Edison. Again, Caterpillar flying high, seems a little bit higher risk with its earning net income and revenue decreasing and trading at an all-time high. So I'm just kind of cutting that one off and taking those profits. Consolidated Edison, it's a slow grower. It doesn't have anything extremely negative with it, but I'm just going to go ahead and take the equity and move it into something a bit better. Chevron here is the other and third position that I do plan on selling. So Chevron, it's not trading at an all-time high. So let's go ahead and just look at the price over the past 5 years here. We can see here back in 2020 had a massive dip. Now, if you bought Chevron during the March of 2020, you are up very nice. But here, Chevron recently hit a little bit above 108, could have been $110, and has been sliding. Oil prices, I know here in Oregon, I just paid for gas yesterday at Fred Meyer's for about $3.07. So I think at this time, with the recent increase with oil prices, with the recent spike in oil businesses, I've covered Exxon and Chevron in our stock market weekly recaps. They've had a lot of recent positivity, but I feel like this is one of those opportunities where Chevron, it's up 2.3% in my portfolio. It's been in my portfolio for quite a while. I think those funds can better be used. Again, if we look at the revenue, net income, free cash flow over the past 5 years, let's go ahead. I have something else in here, earnings per share. We'll leave that one there. But we can see that this one, along with Caterpillar, it doesn't have the best financials right behind it. Revenue has been decreasing since 2019, down to $94.4 billion. Its net income is negative $5.5 billion. Its free cash flow doesn't really matter too much here, so we'll kind of remove that one. Earnings per share has dropped to, that's normalized. Let's go ahead and just look at for the current year. So earnings per share, it is expected to have earnings per share of $5.26. So that's not too negative, if they can kind of stay true to that. And let's see here. PE ratio is in the blue at a 42.77. So take a look at the PE ratio, and this could just be because of their earnings per share having dropped while their stock prices still remain high. So where is it here? PE ratio is at a 42.77. So that is pretty high. If we look at the PE forward, what is that at? At a 19.61. And that's if they can come in with their expected earnings per share and their price doesn't skyrocket. Right now, with where their price is at and where their current earnings is estimated at, they're looking at a 42.77. So again, I can kind of, it's not that the business in itself is negative. I mean, its revenue decreasing? Yeah, its revenue was decreasing, and its net income is in the negative. So eventually, maybe they could be taking on some debt here. So let's look at their debt load. Yeah, so over the past 5 years here, they had dropped in 2020 to, let's go look at 3 years here. We can probably see a better picture. Nope, 3 years is that. So right around 3 years, they may have had around 26, $27 billion of debt. Well, recently, within 2020 and 2021, they basically doubled their long-term debt from 26 billion to 43.8 billion. So that's a ton of debt that they're taking on here recently, and their cash and equivalents has been slowly decreasing. If we look at the past 10 years, back in 2013, looked like they had a solid amount, over $12 billion of cash and equivalents, and they basically have that now going into 2021 at a 5.5 billion. So ton of long-term debt and very small amount of actual cash and equivalents in a business that is kind of, I wouldn't say super risky. I know a lot of investors are still really interested in oil assets, 239 billion versus liabilities 107 billion. So, not bad overall. I just feel that, again, this one in the portfolio, it's at a good position where I'm still positive. I can let it go. I'm barely positive on Consolidated Edison and Chevron. So by just kind of cutting these positions off, I can move those funds into some other positions that I think have a better opportunity for me. So one of them here that I'm going to be buying today, let's go ahead and go back over here and kind of refresh this page. Okay, so let's go into some positions of potential buy. So I had looked at Digital Realty Trust. This is one that I had considered a bit more, adding a bit more to my portfolio. It is up roughly 23.25%, but I still feel like it does offer what I feel would be a really good opportunity. I had bought it back not too long ago. So if you look at the activity, I had purchased it back on March 29th at $142. This one, to me, when I look at this company just kind of visually here on the chart, it does look like it has much more upside potential versus downside potential. But when I start looking at its revenue, net income, its PE ratio, and what was the other one here? Its earnings per share for the current year, this is where it starts to get a little bit more rocky. So this one, it's priced about in the middle versus its highs and lows. It has its revenue growing steady at 3.9 billion. It has a net income ratio or net income that has been growing steady. Here in 2021, it is looking like it's going negative, but it's hard to tell here in the short term. It always looks like that first quarter, it kind of goes up and then it kind of drops back down. So here, it kind of does the same thing. So I think it's just the way that the company kind of goes as far as their net income goes. They probably have a really profitable quarter that bumps up their net income, and then throughout the rest of the year, as they're doing the renewals, I know we use a DR site where I work, and they're just a large data center, has a ton of different racks. The companies rent these racks out, they buy their own servers, their network equipment, they get them set up, and then they just kind of work as a redundant location. So Digital Realty Trust does a lot of the same thing. And here we can see that their PE ratio is at a 131.52. I actually confirmed that over at Seeking Alpha. I went ahead and took a look at their current PE ratio. No, I just saw it earlier. It's probably right there in front of me and I'm not seeing it. No, I know it's here somewhere. PE ratio right there, 143.62. So I know this is fairly accurate at 131.52 because of the price maybe coming down and kind of fluctuating. Earnings per or the PE ratio kind of fluctuates. Wherever you're looking at it at, it's not always accurate, but that's fairly close to where it is. So it's way up there in the hundreds. Its earnings per share has been really fluctuating. 2019. They started to get profitable here, generating an earnings per share, and it really fluctuates here. It's at $1.31 and some change. And when I looked at even their PE forward is at 111, so not big there. Price to book looks pretty solid at 2.4. I don't think this is a sales-driven company. They don't have a lot of products that they sell. So yeah, their PE price to sales ratio is at a 9.8, but overall price to book ratio seems pretty solid there at a 2.4. But I feel like this one, it may offer really good returns in the future as far as where they're going. Market cap wise, market cap is at, in the brown, 41.41 billion. So that's a pretty beefy company. They do have a ton of debt. So that was another thing that I had potentially thought of buying this one as my third stock to buy, but their long-term debt just exceeded 13.3 billion, whereas their cash and equivalents is at 108 million. So I'm going to let Digital Realty Trust kind of ride itself out and see where this one kind of goes. I'm not going to be selling out of it. I'm not going to be buying more. And we already kind of covered AT&T. So Digital Realty Trust was going to be one of the third positions I was going to buy. But at this time, I'm just going to hold off on purchasing it. Now, let's go ahead and cover Johnson & Johnson. This one just had its vaccine halted because of a blood clotting issue. I think there was some 8 or so different individuals that several days or weeks after they had got the injection had some issues, some side effects of it. So Johnson & Johnson is taking a bit of a beating right now, coming off those highs back in January, I think it was. So yeah, back in January, late January, it had hit roughly $170 per share. It's pulled back about $10 since then. I could have bought this early on in March and had a better opportunity down below, looking in the 150s, low 150s. But here we are looking at it in the 160s. Now, Johnson & Johnson is a great company, just kind of go-to business that really isn't as beefed up as I thought it was in my portfolio. So when I look at Johnson & Johnson, I only have $842 invested in it. It's up roughly 17.2% in the market. So there's much more potential for this one just to kind of buy the shares. It's one of those, it's not exactly a slow mover, not like a utility company would be. So this one does have a bit more potential. You can see that there's always something in the news with it, vaccine wise or baby powder or whatever else. Johnson & Johnson has a ton of different products out there. So there is that side of the risk to being involved in this business. But let's take a look at their PE forward. Forward PE is at a 16.84. This is a sales-driven company. It's a high PE price to sales at a 5.1, but that's pretty normal for Johnson & Johnson. If we take a look at their long-term debt and cash equivalents, long-term debt is at 35.2 billion versus cash and equivalents of 13.9. This one isn't super crazy risky. That's completely normal. That's not bad at all. That's a little under 3 times the debt versus their cash and equivalents. And Johnson & Johnson, one of those household names that you probably have some Johnson & Johnson product within your home. So I don't feel it's too risky. It's just one of those positions that I kind of want to beef up. I'm looking at different positions in my portfolio that I can kind of beef up to get over that $1,000 point and continue growing this portfolio a little bit larger. So Johnson & Johnson is one that I'm going to be moving into. And I did post a picture of Kimberly-Clark not too long ago, kind of going over where they were at. So back on, let's see if we take a look here. I got so many notifications here. Kimberly-Clark right here. So they are currently, back at the time when I did this, it was at 136.98. Where are they at now? 138.94. So they've moved up about $2, but they still have a high of around 160. So there's still some upside potential, but there's also some downside potential here in the short term. They are trading with a starting yield of, I think they just recently increased their dividend. So what did I say here? 3.33%. Yeah, I think that's more accurate. So they have a dividend. They're paying out $4.56. So calculator, 456 divided by 138.94 times 100. That gives them a starting yield of 3.28%. So yeah, this is a little bit wrong at the moment just because I don't think this one has their recent dividend increase that they just announced here in that last quarter. So they went from $1.07 to $1.14 in Kimberly-Clark there. And let's go ahead, Now, as far as the revenue, net income, and free cash flow, that is all looking pretty straight. If we look at this over the past 5 years, and let's go ahead and bring in their earnings per share into here as well. We can kind of look at the pattern here over the past 10 years. So revenue has been steady. It's not really going anywhere at a 19.14 billion. And this is a very large company. They have tissues, diapers, men's products, women's products, tons of different products out there for household names, similar to Johnson & Johnson. And their net income has been steadily growing as well. So you may not see the growth here if I put in the percentages here of how they've changed. So revenue has been steady but declining, down 5.91%, but not one of those risky factors. Over the past 10 years it looks negative. If you look at it over the past 5 years, even during what happened back in 2020, March 2020 here, we can see a little increase in their revenue from all those diaper sales, toilet paper sales. I don't know if they have any toilet paper, but we do see an increase there in their revenue. Also, net income and earnings per share have been growing nice and steady going out of 2020. So really good right there. And I could talk about their debt as well. Let's go ahead and bring that in. Go back to the original. So they actually have a fairly low amount of debt. So 8.3 billion, in the grand scheme of things, really large business here. This one, I feel like $8.3 billion of debt is actually pretty tiny in comparison to some of the other businesses that are out there. Cash and equivalents of 303 million. If we look at their assets and liabilities, they have $17.52 billion of assets, $16.65 billion of liabilities. Return on invested capital is sitting at a very double digit there of 27.23%. PE ratio, this is a sales-driven company. So price to sales here is at a 2.48, so pretty solid there for a sales-driven business, and a PE ratio below the S&P 500. So overall, I'm going to be buying some Johnson & Johnson and some Kimberly-Clark. I considered buying some Digital Realty Trust, but at this time, I think we'll go ahead and kind of sell off these 3 positions and then add a little bit to both Kimberly-Clark and Johnson & Johnson. And then we'll still have some funds left over to kind of take a look at the portfolio again here in the future and see, what are some other opportunities that we can go ahead and get into. So Consolidated Edison, it can move up tomorrow. So always oversell anything. So here I am selling. I have $1,000 worth of value. I'm going to sell $1,200 of value in case tomorrow, for whatever reason, Consolidated Edison goes up double digits. Then we're going to go ahead and go to Caterpillar. Caterpillar up very nicely here. We're going to go ahead and sell off our position. It's got a little over $1,350 of value, so we're going to go ahead and punch in $1,500 here, continue and sell. And our last position here that we're going to be selling is Consolidated Edison, ticker symbol ED. Oh, already got that one. Selling Chevron. That's right. Oh, right there. We're going to go ahead and sell up Chevron here and sell. We're going to go ahead and punch in $1,000 right there and sell and confirm. Okie doke, we've done our sells. Let's go back into our portfolio and take a look at Johnson & Johnson. It's got about $800 invested into this position. So I'm going to go ahead and add $500 into Johnson & Johnson at this time. I would like to beef it up to about $1,500, but if it does go down here in the short term, I'll probably add more to Johnson & Johnson as well. And then our other buy here was Kimberly-Clark, ticker symbol KMB. I'll probably add another $500 here to Kimberly-Clark as well, just to kind of make it even and fun there. Okay, so we've made our 2 buys, and kind of looking at our portfolio, I think we're pretty happy with the performance of where it's at. I'm going to continue to take a look at other positions within the portfolio and other stocks. I haven't, there's definitely a ton of stocks out there that need to be researched. It's really hard right now to find any value in the market worth buying, But I do believe that Johnson & Johnson, even though it is hit right now with the vaccine getting halted, I think that that slight dip there does offer a nice opportunity. Kimberly-Clark, it's definitely been doing really well during these current times. It's had continued earnings per share, growing net income. Revenue has been decreasing steadily over the past 10 years, but over the last 5, they've been picking it back up. And not a bad company. You know, starting yield over 3%, I believe, on both of these. And Johnson & Johnson down at 2.52. But, you know, continued dividend growth of some crazy amount of years. So they're both dividend aristocrats. So that is going to be it for this video. Very long video. Hopefully it was fun and entertaining. If there's any comments or questions, let me know down in the comment section below. But otherwise, thank you all for tuning in. Let me know down in the comment section below, is there anything else you'd like to see discussed here on the channel? So that is it for this video. If you guys have enjoyed it, again, go down below, hit the red button to subscribe, make it great. Hit the bell to be notified every time I release a brand new video. And of course, give this video a thumbs up, make it blue. And I will see you guys in the next video. Bye-bye.